How a 5-second trick let traders drain millions from Polymarket. The old approach just got more expensive. The practical edge now comes from changing process, timing, and tooling together. We will map trigger, incentive shift, and downstream impact before the close. Here's how it happened, why it matters to anyone holding crypto, and what's about to change in how prediction markets work. Last week, someone discovered a vulnerability in Polymarket's order matching system. Not a hack in the traditional sense, there was no code injection, no compromised wallets, no phishing. Instead, they exploited a timing gap. When large orders hit the market, there's a microsecond window where the price hasn't updated but the contract is still accepting trades at stale prices. A trader could submit an order, watch the price move in their favor mid-execution, and exit before the system caught up. 5 seconds. That was the entire window. And in that 5-second gap, millions moved. Here's what makes this particularly instructive. Polymarket is one of the largest prediction markets in the world. We're talking about a platform where traders bet on elections, sports outcomes, business milestones, and geopolitical events. The volume there is real, tens of millions weekly. And if someone can drain that much capital in 5 seconds by simply understanding the order matching latency, it reveals something uncomfortable about how these platforms are built. The exploit works because of a fundamental mismatch between human perception and machine timing. When you submit an order on Polymarket, your order doesn't instantly settle. It goes into a mempool, gets ordered, processed, and confirmed. During that processing, call it 200 to 500 milliseconds, other traders' orders may have already moved the price. But the contract doesn't know that yet. So it matches your order at a stale price. If you're sophisticated enough to understand that delay and have the capital to move fast, you can capture the difference. The trader in this case did exactly that. They spotted the pattern, scaled it, and executed it repeatedly until the platform operators noticed unusual activity. Why does this matter beyond just hackers are scary? Because Polymarket doesn't have circuit breakers. Most traditional exchanges have built-in safeguards. If the price moves too fast, trading halts for a moment. Not here. Polymarket was optimized for speed, not for protection. The trade-off was implicit. Faster execution meant less slippage for normal traders, but it also meant less time for the system to detect and stop anomalous patterns. Now for the second-order effect. This wasn't just about one platform. If Polymarket has this vulnerability, so might every other decentralized exchange, every AMM, every order book running on-chain. The exploit is reproducible. A 5-second latency gap isn't unique to Polymarket, it's baked into how blockchain systems work. Transactions take time to be included in a block. Blocks take time to be mined. Confirmation takes time. During all of that time, a sophisticated trader can see an opportunity and front-run it. Here's the contrarian angle nobody's talking about yet. This exploit actually exposed a structural truth about crypto markets that needs to be known. Traditional finance hides this stuff behind market maker obligations and SEC reporting requirements. But crypto, by design, is transparent. Every transaction is visible on-chain. So instead of this vulnerability being discovered in secret by a firm that profits from it silently, it happened in public. Someone saw it, exploited it, and now the entire ecosystem knows the vulnerability exists. That's not great for Polymarket's credibility in the short term, but it's the fastest path to a fix. What changes next? 3 things. First, Polymarket is likely implementing order matching improvements, maybe commit reveal schemes, where you submit an order hash first, then the actual order later, breaking the window where someone can see and front-run your trade. Second, other platforms will audit their own latency. If they haven't already, they will. Third, this becomes a regulatory talking point. When Congress or the SEC asks, how can we be sure crypto markets are fair, this exploit is Exhibit A. It'll be cited in every hearing on crypto market structure for the next year. For traders and investors, the lesson is simple, decentralized systems move faster than traditional ones, but speed comes with new types of risk. A 5-second latency window is a feature, not a bug. It's what makes decentralized exchanges possible. But it's also what makes them exploitable if you don't have safeguards in place. The best platforms will be the ones that acknowledge this tension and build controls that slow down only the bad actors, not the good ones. This is worth watching because it's going to reshape how crypto markets design their execution engines. Polymarket will recover, fix the issue, and move on. But the next platform that doesn't see this coming could lose a lot more. Subscribe for daily intelligence on markets, crypto, and the systems underneath them. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.